Recession. You probably would have heard this word on the news, in financial reports, or just in some random conversation. It usually accompanies a sense of fear or panic, as if there's about to be an outbreak of a pandemic of some sort. But practically, it's an unavoidable and natural part of the economic cycle, and every country experiences some form of it from time to time. Hey guys, welcome to another exciting video by Finance Aligned. In this video, we'll share some tips on how to invest during a recession in order to help you plan your life ahead of or during a recession. Before we continue, kindly like this video, subscribe to the channel, and hit the bell icon to stay notified of more exciting videos just like this one. Let's get right into the video. So, what exactly is this recession all about? A recession is a prolonged period of economic decline marked by rising unemployment and declining trade and industrial activity. Recessions may only last a few months, but it can take years for the economy to bounce back and reach its previous peak. Companies sell less during recessions, and economic growth slows down or stops entirely. One notable aspect of recessions is unemployment. Companies will require fewer workers if demand for goods and services declines, and they may fire employees to reduce expenses. Employees who are laid off must reduce their own spending, which lowers demand and increases the likelihood of additional layoffs. Recessions can increase uncertainty and volatility in investment markets. Choosing where to invest your money during a recession or economic downturn can be difficult and stressful. Wild swings can be frightening, but they can generate opportunities. Is that a reason to stay away and avoid the risks? Or should you dive in and hope for the best? Here are some tips for investing in a recession. Number 1. Get cash reserves. Cash is king during recessions, according to Citi Global Wealth advisor Michelle Griffith. It's better to be safe than sorry and beef up cash reserves during a recession, as businesses scale back and job losses mount. Before now, you should have been building emergency savings. If you haven't started saving, you should start sooner because it's one of the tools you would need to weather any economic uncertainty and crisis. There is a reason the emergency fund consistently ranks as one of the most important financial strategies. The possibility of losing a job or paying off a lot of debt is one of the main risks for people during a recession. It's easier to face uncertainty with more confidence when you have a strong cash reserve behind you, because you'll know you're ready financially. It's important to keep your emergency fund accessible and liquid by keeping it in a high-yield savings account or money market account. Also, your money can earn more in a savings account as rates climb during a recession. Number 2. Use dollar cost averaging. Dollar cost averaging is a practice that involves investing a fixed sum of money on a recurring basis over a certain period, regardless of the price of the investment. This is a tactic that can lower your investing costs and reduce risk at the same time. Many people have tried to time the market to purchase assets at low prices. In theory, this seems simple enough. Practically speaking, it's nearly impossible, even for experienced stock pickers. Dollar cost averaging allows you to invest the same amount every time, regardless of whether the market is trending up or down. By continually investing the same small amount in an item, dollar cost averaging removes the emotional component from investing. By doing so, you can acquire more shares at cheaper prices and fewer shares at higher prices. Dollar cost averaging's benefits is that you can buy at both low and high prices by making regular little investments over time. Your average purchase price is rounded off by doing this. In times of economic recession and weak markets, dollar cost averaging can be very effective. As an investor, you might find the best discounts when the market or a stock is down. Therefore, committing to this strategy means investing during those times. Furthermore, attempting to time the market can be very costly. Charles Schwab found that investors who tried to time the market made significantly less money than those who invested regularly using dollar cost averaging. Dollar cost averaging still contributes to the growth of your money. According to research by the Financial Planning Association and Vanguard, investors who employed dollar cost averaging did experience significant investment growth, just occasionally a little less than they would have if they had made a lump sum commitment. Number 3. Invest in non-cyclical stocks. Non-cyclical stocks are those whose products people will continue to buy even if the economy is in recession. Consumer staples like food, gasoline, utilities, and pharmaceuticals and healthcare are common examples. Non-cyclical investments are generally profitable regardless of economic changes because they produce or distribute goods and services that we continually need, like food, power, water, and gas. Stocks of companies that produce these goods and services are also known as defensive stocks because they can protect investors from the effects of an economic downturn. No matter how badly the economy is doing, people still need to eat and use household products. So sales of consumer essentials like food, beverages, and household goods are largely recession-proof. Utilities outperform other stock sectors during a slump because demand for them remains stable, even in a recession. An important fact about non-cyclical stocks is this. Although they offer safety, their prices won't rise dramatically when the economy recovers from the recession. Number 4. Invest in dividend stocks. Dividend stocks describe stocks and companies that routinely transfer profits to their owners, most frequently in the form of cash. Although not all stocks pay dividends, those that do usually do so regularly, often quarterly or yearly. You'll receive payments based on how many shares you own, and the actual payment will depend on how much the company made during the payment period. Businesses that generate high revenue can, in general, use this extra cash in 3 main ways. They can use it to buy or invest in other businesses, reinvest it in their own, or give it back to shareholders as dividends or buybacks. Typically, businesses that begin paying dividends have enough spare cash flow to make payouts year after year. So because these businesses have very good finances and generate enough cash flow from massive profits to continue paying dividends, investing in them is less risky. One of the last things a company wants to do is cut the dividend because it frequently indicates financial strain and diminished trust in the company. For this reason, business management frequently continues to pay a dividend even when stock prices are falling and investors are in a panic, provided that doing so does not jeopardize their ability to fulfill other important obligations like making debt payments and investments to keep their businesses afloat. Investors who are concerned about a downturn in the economy might want to think about increasing their holdings in dividend stock funds, which have often performed rather well during recessionary periods. An analysis by Morningstar, a financial services company, discovered that dividend stock funds are frequently quite effective at outperforming a downturn. The top dividend stocks give your portfolio a cushion during downturns. A company may continue paying dividends despite a decline in the value of its stock. If you're going to invest in stocks during a recession, it's preferable to buy established large-cap firms with solid cash flows and balance sheets. In addition to being more likely to pay dividends than smaller businesses with weak cash flows, these corporations are better equipped to withstand economic downturns. You can purchase dividend stock funds in different ways. The simplest is to choose the one you like from a fund company you trust and invest in it. You must open an account and invest with the company issuing the stock. If you're optimistic about investing yourself, a financial advisor can assist you if you need assistance investing in dividend stock funds. The best dividend stocks can also be great strategies to build long-term wealth, while also being another great source of income. Number 5. Make investments in gold and other precious metals. During economic and market recessions, precious metals like gold and silver frequently do well. However, because there's typically a rise in demand for certain commodities during recessions, their prices typically increase as well. Gold, silver, and other precious metal bullion prices are not associated with those of other investments. So when other investments lose value, gold is viewed as a haven asset. As a result of the high demand from investors looking to spread their risk and diversify their portfolios, it's true that the price of gold typically rises during recessions. Every asset loses value during a recession, including stocks, real estate, and personal property. Although money is frequently taken out of investments like stocks and shares during recessions, money itself also depreciates. Gold, on the other hand, retains its value, unlike cash, and does well during recessions. Its scarcity, reputation, and precious metal value contribute to its value. An individual who purchased gold is likely to have minimized losses, or would have made money at the end of a recession. The fact that gold is held as a reserve asset by central banks is not a coincidence. When gold is referred to as a haven, it refers to the perception of it as a reasonably safe asset during times of high inflation or market volatility. There are numerous ways to invest in precious metals. Purchasing coins or bars from a vendor or coin dealer is the simplest option. Although this is not the same as purchasing a security, it's still a viable choice. Number 6. Diversification. Diversification is the process by which investors create diverse portfolios of shares and other assets. However, they are not excessively dependent on the performance of any one investment or asset type. Diversification is used to reduce risk. Investors diversify their portfolios by spreading their money over a variety of companies, industries, sectors, and asset classes rather than concentrating on a single one. Spreading your money among domestic and international, big and small, and domestic and foreign stocks and bonds reduces the risk of having all your eggs in one basket. There are many different diversification techniques to pick from, but they all include investing in a variety of various asset types. According to investment guru Sir John Templeton, the only investors who don't need to diversify are those who are always correct. Nobody is, so it makes sense to plan for many outcomes and spread your funds around so you're not dependent on a particular business or industry. So in a scenario where one sector is doing badly due to the economic swindle, you can still bank on investment in another completely different sector. And lastly, number 7, don't get emotional. It's said that emotions cloud judgment, and an individual must be in the right emotional state when making decisions that concern his or her finances. Experts frequently stress how crucial it is to control your emotions when there is a downturn, which frequently occurs during recessions. Emotional judgments can derail even the best financial strategy. Whatever strategy works best for you, avoid allowing your emotions to influence your decisions. Investing during a recession is possible and could also be an opportunity to build your finances if the right methods, decisions, and risk tolerance are utilized appropriately. Nobody can predict how long or how much a recession will affect the stock market, even if one is approaching. It can be frightening to invest during recessions and unpredictable markets, but the most important thing is to maintain a proper balance. In many situations, doing nothing at all is the wisest course of action. You can put your faith in the market's durability and the diversification you've included in your long-term portfolio. So that's it for today. What do you think about this video? Kindly let me know what you think about this video in the comments section below. Don't forget to like and subscribe to this video. Also hit the bell to receive more updates. See you next time. Thanks for watching.